Америка прямо сейчас пытается поменять правила на рынке золота и криптовалют. Вспомните, какой у них долг. 35 триллионов долларов. В общем-то, это два альтернативных валютному сегменту мировых рынка. Действия Вашингтона в этом направлении отчетливо демонстрируют одну из главных американских задач. Они очень хотят решить проблему снижения доверия к доллару. США, как это было и в 30-е, и в 70-е годы, будут решать свои финансовые проблемы за счет всего мира, загоняя всех куда? В криптовалютное облако. Со временем, когда часть госдолга США будет размещена в стейблкоинах, США обесценит этот долг. Еще раз простыми словами, у них сейчас валютный 35-триллионный долг, они его загоняют в крипту, в облако, обесценивают и начинают с нуля. Это для тех, кто очень любит заниматься криптой.
We've already uncovered the uncomfortable truth. Since the dot-com bubble in 2000, we've been living in a silent depression. In dollars, it looks like growth. But in gold, and even more in Bitcoin, we've been sinking for 25 years straight. So the real question is, where do we go from here? Because you don't escape a depression by accident. You escape by walking through one of three doors. And today, I'm going to lay them out for you. The first door is Repression 2.0, the CBDC world. The second is the Digital Gold Breakout, Bitcoin as the new reserve. And the third is the most dangerous, the big snap, a disorderly reset, or even war. Each door has winners. Each door has losers. And if you don't understand which path the world is walking, you will be on the wrong side of history. Let's break them down. Here's the problem in plain English. In the fiat system, almost all growth now comes from credit. Governments borrow, companies borrow, households borrow, and that new money shows up as GDP. But here's the catch. Total global debt today is over $300 trillion, about 3 times global GDP, which means every new dollar of growth requires more and more borrowing. In the 1950s and 60s, $1 of debt created nearly $1 of GDP. Today, in many economies, you need $3 to $5 of debt just to create $1 of GDP. That's called debt saturation. The system is so leveraged that new borrowing doesn't produce real growth anymore. It just keeps the wheel turning. So when you look at global GDP in fiat terms, it still ticks upward. But most of that is recycled credit. Governments rolling over old debt, central banks refinancing, companies borrowing to buy back stock instead of building factories. That's why in fiat, we're hitting a wall. There's no fresh productivity expansion, just a bigger and bigger debt spiral, keeping the illusion alive. And that's also why, in gold or Bitcoin terms, it looks like stagnation or outright depression. Because once you strip away the credit, there isn't much real growth left underneath. Now, let's play the optimist for a second. What would it actually look like if we got out of this depression? Now, let's play the optimist for a second. What would it actually look like if we got out of this depression? So, here's the real question. How do we know when we've finally escaped this depression? Forget the government press release. You measure it in gold or in Bitcoin, and you need to see improvement for at least 3 to 5 years straight. 1. Median household income in gold, growing at 2% or more a year, and not just for the top 10%, but for the middle class. Median household income in gold, 2% CAGR. CAGR stands for Compound Annual Growth Rate, a financial metric that measures the average annual growth of an investment or business over a specific period, assuming that profits are reinvested each year. It provides a smoothed annual rate of return, eliminating volatility and making it easier to compare the performance of different investments over time. 2. Real economy investment per worker in gold, up 3% or more per year, meaning companies are putting real capital into production, not just buybacks or speculation. 3. Energy-adjusted productivity. More output per kilowatt hour, measured in gold. Energy is the foundation of real growth. 4. Housing affordability in gold. The price-to-income ratio stabilizes or even narrows. People can actually buy homes again without being debt slaves. 5. Debt service in gold, public and private, flat or falling relative to GDP. In plain English, we're not drowning in interest payments anymore. Hit most of those targets: income, investment, productivity, housing, debt, all in gold or Bitcoin terms. And congratulations, that's when you know we've exited the depression. Until then, everything else is just a fiat illusion. In fiat terms, the paths exist. 1. If fiat keeps inflating the likely path without reform, you'll see booming numbers on paper. GDP, wages, stock markets all look like they're flying. But in gold terms, real wealth stagnates or even falls. That's the world of the vibecession. Official numbers are fine, but everyone feels squeezed. 2. If fiat resets or anchors back to something hard, like gold or even Bitcoin, then you get the opposite. Immediate shock. Currencies devalued, bubbles, pop, pain in the short term. But the payoff is a healthier, more credible system long term. Okay, we've diagnosed the problem. Now let's map the exits. There are 3 plausible futures the world can walk into next. I'll name them, give probabilities, list the triggers and leading indicators, and explain what each one means in gold terms and in fiat terms, plus who wins, who loses, and how you might position yourself. Scenario A. Repression vinci. The CBDC stablecoin world. Probably approximately 45%, most likely near-term path. Governments and central banks roll out CBDCs plus regulated stablecoins as the dominant money rails and use them to control capital flows, steer savings into public debt, and keep yields low. Monetary policy becomes more surgical and surveillance-enabled. Within the next 1 to 5 years, expect rapid CBDC pilots to turn into full legal frameworks. At the same time, governments will tighten the screws on private stablecoins and crypto on and off, pushing people toward the official rails. And in the background, central banks will keep real interest rates near zero or even negative and run round after round of quantitative easing to keep the debt system alive. In this scenario, money goes fully digital, programmable, and centrally controlled. On the surface, it will feel convenient, instant payments, no more cash. But underneath, it's financial repression, savings funneled into government debt, negative returns for the middle class, a never tighter surveillance on where money flows. Watch for these leading indicators. First, legislation rolling out central bank digital currencies and placing strict limits on anonymous transfers. Translation: the end of private cash. Second, new rules that quietly force pensions and insurance funds to hold more government bonds. That's financial repression dressed up as prudence. Third, real interest rates stuck near zero, even when the economy is supposedly growing. That's how you know debt service, not productivity, is running the system. If you see these 3 things line up, congratulations, you're living in Repression 2.0. The CBDC world isn't just coming, it's already here. So what happens if we enter the CBDC world? In fiat terms, it actually looks pretty good at first. Nominal GDP keeps rising. Stock markets and real estate keep hitting new highs. Debt to GDP looks stable because financial repression forces savings into government bonds. On the surface, there's growth, but underneath, income inequality keeps widening, and savers in fiat get punished. Your money buys less every year. In gold terms, the story is very different. Gold and Bitcoin keep appreciating, exposing the weakness of fiat. Real GDP and wages in gold stay flat or even fall slowly. In other words, there's no real escape. The depression continues. Maybe it feels softer than a sudden crash, but it's a long, grinding stagnation. The winners are state-backed institutions, the big banks, anyone with political access, and owners of real productive assets, as long as they can still get financing. The losers are ordinary savers holding cash or fixed income products, and wage earners stuck on fiat incomes. They'll be squeezed year after year. How to prepare practically? Keep exposure to hard assets, gold, Bitcoin, or select productive real assets that can't be printed. Use compliant crypto rails sparingly, but prioritize custody setups that can survive regulatory pressure. And most importantly, diversify across jurisdictions. Understand the on and off-ramp rules for CBDCs before they close the exits. That's Repression 2.0. A slow squeeze disguised as stability. Scenario B, Digital Gold Breakout Bitcoin becomes a global hard money. Probability approximately 30%. Core idea: Bitcoin, or a comparable decentralized reserve asset, achieves sustained institutional adoption as a global non-sovereign store of value. It becomes a parallel monetary standard for savings and cross-border value, capping fiat credibility. Over the next 3 to 7 years, institutional adoption keeps building. We're already seeing Bitcoin ETFs in the US and Europe. Corporate treasuries will follow, allocating part of their balance sheets into Bitcoin as a hedge against fiat decay. Even sovereign wealth funds and central banks may quietly accumulate. On-ramps will mature and normalize. Today, it's still clunky. Exchanges, KYC, hurdles, custodial headaches. But as regulated gateways grow and custody becomes more robust, Bitcoin becomes as easy to buy and hold as any ETF or stock. That's the timeline, a slow but steady transition where Bitcoin goes from outsider to parallel reserve asset. And once sovereigns join the game, it won't just be an option, it will be a new foundation for savings. What happens in fiat terms? Fiat volatility explodes. Central banks lose their grip on long-term expectations. When savers and institutions start benchmarking wealth in Bitcoin, fiat currencies look unstable by comparison. Asset bubbles appear and burst. As capital flees fiat into Bitcoin, stocks, bonds, and even housing may see sharp inflows and outflows. Prices jump, then collapse, then rebound. Not because of productivity, but because capital is searching for safety. Short-term pain for the fiat. If you're holding cash, bonds, or earning a wage denominated in dollars or euros, your purchasing power swings wildly. One year it feels like a boom, the next like a bust. Nominal numbers, the ones you see in headlines, may soar or crash, but they'll mean less and less in terms of real stability. In other words, fiat becomes the volatile side of the trade. Bitcoin becomes the benchmark. What happens in gold terms? Bitcoin competes with gold as the ultimate scarce measure. In BTC terms, fiat-denominated GDP wages collapse even faster. Gold may still hold value, but BTC becomes the sharper truth meter. The depression measured in BTC looks deeper, but BTC holders gain extraordinary purchasing power. Winners: the early and patient Bitcoin holders, the developers and builders creating open financial rails, and the global savers fleeing fiat decay. These are the people and institutions positioning themselves ahead of the curve. Losers: the financial incumbents who can't adapt, the fiat-only savers stuck earning in melting currencies, and entire countries that choose to ban Bitcoin and isolate their capital. Those nations risk watching wealth and talent flow across digital borders they can control. It's a redistribution event, not through taxes or politics, but through technology. The map of global wealth gets redrawn. So how do you prepare if Bitcoin becomes the parallel reserve? First, custody and security. Educate yourself. Keep at least a portion of wealth in non-custodial wallets. If you don't control the keys, you don't really own the money. Second, core allocation to hard money. Balance your exposure. Gold for legacy stability. Bitcoin for digital scarcity. Size it to your risk tolerance, but don't sit entirely in melting fiat. Third, liquidity across borders. Hold cash or equivalents in multiple currencies and jurisdictions. If one system tightens the exits, you've got alternatives. Preparation here isn't about betting everything on Bitcoin. It's about building resilience in a world where money itself is being redefined. Scenario C, trigger E. Timeline, the debt snap. Probability 25%. The credit system reaches a terminal point. A sudden loss of confidence or major credit event forces it. Rapid delevering. The debt snapped. The point where the global credit system simply breaks. Here's how it could unfold. A sharp global funding shock. It could be a repo market blowout, a cross-currency dollar squeeze, or a sovereign credit event that cascades through the system. Defaults spread like wildfire. It starts in shadow banks, over-levered corporates, or soft currency. Sovereigns. Within 0 to 5 years, the dominoes can fall fast. Once confidence in the credit system cracks, there are only two paths. C. 1. An orderly reset. Restructurings, controlled defaults, temporary capital controls leads to short, deep recession. Then recovery under new rules. Fiat values repriced. Painful but survivable. New monetary regime, painful but managed. C2, a disorderly war reset. Governments militarize, resource grabs and destruction create a physical reset. Fiat chaos, hyperinflation in places, and long-term human trauma that breakdown spills into geopolitical conflicts, financial stress translates into real war. This is the scenario central banks fear most. Not a slow squeeze, not a technological transition, but a systemic heart attack. So how would you know if the debt snap is coming? The signs show up before the crash. First, credit spreads blow out. The gap between safe debt and risky debt suddenly widens. When sovereign spreads jump overnight, confidence in governance themselves is cracking. Second, cross-border dollar shortages. Emerging markets scramble for dollars. FX reserves get drained and currencies seize up. That's a signal the plumbing of global finance is freezing. Third, dysfunction in short-term funding. Runs on commercial paper. Repo market seizures. The pipes that keep credit flowing. When those jam, it's game over. These are the smoke signals before the fire. Ignore them, and the reset catches you by surprise. In fiat terms, this are the scenario. What happens in gold terms? Immediate spike in gold and BTC as safe collateral. Gold price, GDP collapses hard during the shock. Long-term outcome depends on post-reset policy. Either low real output for years, or eventual reconstruction-led recovery like post-World War II, which could improve gold term metrics only after huge human and capital loss. Winners, losers, and how to prepare the debt snap. In Fiat debt snap, wealth isn't about paper claims. It's about survival and leverage in the real economy. The winners, those with real, productive collateral farmland, energy, critical infrastructure, those with global mobility, able to move capital and themselves. Holders of physical hard money and control of logistics. The losers, the debtor classes, the leveraged finance players, and whole populations trapped in conflict zones. When credit collapses, leverage flips from a tool into a weapon against you. How to prepare? Protect liquidity and options. Hold hard collateral like gold, keep diversified safe havens, and plan for emergencies. Reduce leverage. Don't get caught with concentrated duration risk in sovereign bonds or fragile debt instruments. For creators, focus on building portable, exportable skills and income streams. In a fractured world, your ability to earn across borders may matter more than your portfolio. The cleanest escape from this long depression isn't repression or Bitcoin or a debt reset. It's the hardest path, a genuine productivity surge. What does that mean? A breakthrough in energy, cheap, abundant power that collapses input costs across the economy. Think nuclear fusion or scalable, advanced nuclear or AI as infrastructure, not just chatbot, but a layer that drives real output, automating logistics, design, discovery, and labor at scale. If either of these becomes reality, total GDP expands for real, not just in inflated fiat terms. Wages rise, output rises, living standards rise. That's the true way out. But here's the problem. The likelihood within 10 years is low. Fusion breakthroughs are always 20 years away. Advanced AI is real, but whether it drives broad-based productivity or just pumps asset prices and monopolies, that's an open question. So that is why scenario A and B is most probable. So while this escape hatch exists, betting on it in the next decade is like betting on a miracle. And economies that sit around waiting for miracles usually don't make it. So where are we in the arc of history? For over a century, the world has lived on cycles of credit, war, and reinvention. The Great Depression of the 1930s ended not because of a miracle, but because the world reset through war and industrial mobilization. Nixon's shock in 1971, untethered money from gold, setting off half a century of financialization. The dot-com bubble in 2000 marked not just a market crash, but the beginning of what, in gold terms, has been a long global depression. Since then, we've been trapped in a paradox. In fiat numbers, everything looks bigger: GDPs, stock markets, even wages. But in real money, gold, and now Bitcoin, the story is stagnation, even decline. The system survives by rolling debt forward, refinancing the future into the present. We stand now at 3 doors, maybe 4. Repression 2.0 through CBDC. Bitcoin breakout as a parallel reserve. Debt snap in hard reset, orderly or chaotic. And the rarest, a genuine productivity escape through energy or AI. For young people, this feels like living in the 1930s again. Stagnant wages, unreachable housing, inequality. But unlike the 1930s, we have something new. The internet. Wealth today is mobile. Skills are mobile. Communities can be global. That doesn't erase the depression, but it gives us options our grandparents never had. The century ahead won't be decided by fiat illusions, but by real choices. What money we trust, what technologies we build, and how we adapt.